So today we're going to be talking about the accounting for current liabilities. So like we mentioned before, we started with assets. We started with the fundamental concepts like assets equal liabilities plus equity and trial balance and the accounting cycle. And now we're going to be going into, we covered assets and now we're going to be covering liabilities. Future classes are equity and statement of cash flows. So what are current liabilities? What defines their characteristics? How do we account for them? That's really what we're covering today. So what is a current liability and what's a long-term liability and what are their characteristics? So we've talked about this a lot in class. I'm not going to quiz you again, but while there's long-term liabilities and short-term liabilities, short-term is the same as we did for assets, right? Short-term means that it's within a year generally or within the a business cycle. Most business cycles are a year or less. You take the greater of a year or the business cycle, but most business cycles are a year or less, so you do a year. An example of a business cycle that's greater than a year is like a winery or a vineyard that you take years and years to grow a grape and then process that grape into wine. So you might have a different definition of what a current liability or current asset is. But for this purpose, for this class, we're going to just say current is a year or less. That's the most common business use. And so when we're talking about liabilities, in this class, we're going to be talking about current liabilities. The next class, we'll be talking about long-term liabilities. So current liabilities means liabilities, something we owe to people outside of our business, to debtors or creditors, and that's something that we owe within the next year. So really what we're talking about here is money that we owe outside of our business. So we're not paying our stockholders, we're paying an outside creditor. That could be a bank, that could be an investor who lended money to the business, and it's based on something that we've already done. We have a present obligation. So we have the current liabilities, that's within 1 year, the long term, which is greater than a year. So current liabilities are obligations that are due within 1 year, long term or greater than a year. So what are some examples of this? I mean, this is just repeating the same information, and this shows you what kind of businesses have what kind of liabilities, and this would make as a percentage of their total liabilities. And so you can see kind of the different mixes that certain companies have. Retail companies generally have a lot of current liabilities because most of their inventory is funded by liabilities. We've talked about this in other classes. If you read the book about Nike, the owner of Nike, the way that most retail companies start their businesses, same thing with Walmart, is they will borrow lots of money. It's called being heavily leveraged. They borrow lots of money and then buy inventory with that money from the bank. And then they use that money from the bank and the inventory to create more money, which then they use to buy more inventory and borrow more money. And so you continue to have this large amount of leverage, but you owe that leverage very quick. You have to pay that debt within a year normally because the banks aren't going to lend you money for inventory for greater than a year. So retail companies generally have very high current ratios versus long-term ratios, while the other extreme would be like amusement parks. Amusement parks or hotel chains or real estate companies, they are borrowing large amounts of money for huge construction projects. And so they're normally borrowing debt that's very long-term, not short-term, because they're not selling things quickly. They're selling more of an experience over the long term. So most of their assets, their liquidity is going to be, or their debt is going to be in the long term. So they're generally going to be rather liquid, but have solvency issues, right? We talked about liquidity is our ability to pay money or pay our debt within a year, while solvency is a business able to pay its debt over the long term. So a company like Columbia Sportswear, we'd be more concerned with their liquidity. If they 85% of their debt is due within a year, our question is, can they pay that debt yearly? For Six Flags, we might be more concerned with their solvency. Like, Six Flags might only have a small amount of current debt, but are they ever going to be able to pay? So they have $272 million of current debt from the time of this assessment. But that means that they have probably $2 billion of long-term debt for all of their amusement parks. And so can Six Flags ever be profitable enough to pay off that $2 billion of debt? And so those are the different ways we can think of business and how they operate. Remember, debt isn't inherently bad. And equity isn't inherently bad, right? Each has their own advantages, which you'll learn more about how to get the proper mix for a business in future classes. This is called your CapEx. You can do your CAPM ratios. You can do your cost of capital mixes to figure out what's the best way to approach your capital structuring if you want to do it with debt or equity. We're not going to cover that in this class. Also know it's different for personal finances and business. And personally, I don't believe that it's good for a person to get into debt for investments unless they really know what they're doing. While a business has less risk because they can go bankrupt and they can sell their business and still go live in their own home, right? Well, if you're borrowing a lot of money against your home, it might have an advantageous investment in the long run, but you still have to live out of a home. So just remember that there is a separate considerations for personal finance and for business finance, unless you're a business expert or have a lot of money. So uncertainty of liabilities. So liabilities are complex, right? At the end of the day, we are talking about a rather complex financial instrument. We're talking about a contract that is normally tens to hundreds of pages of a person or a company promising to pay a large amount of money and maybe collateralizing that promise with a house or with a building or with a business. And so there's a lot of uncertainty around these promises, like uncertainty of whom is going to pay. Right? I can promise to pay, but then maybe I can that promise is actually to my business, or that business can assign that promise to other companies. Uncertainty in when to pay. Sometimes liabilities are due monthly, sometimes they're due yearly, sometimes they're due upon triggering events, right? The contract can be structured in any single way. And how much to pay at the time of payment. So how much interest is there? Can that interest change? The interest rates can be variable. So all of these uncertainties make liability accounting rather complex. So we'll go into those details today. Only high level, not into the deep calculations. So what are some known current liabilities? We talk about accounts payable in detail. We talked about accounts receivable, the other end, right? And all those considerations, but we have to worry about accounts payable now, the other side. Sales tax is payable. So if we owe sales taxes, unearned revenues, so deferred revenue, short term, which is also known as a contract liability now. That's a new terminology. So unearned revenue, deferred revenue, and contract liability are all synonymous terms. Short-term notes payable. So that means that we owe a debt to a creditor within a year. Payroll liabilities, so our liabilities that we owe for our staff. And then multi-period known liabilities, which we'll go into a little more detail. So let's talk about sales tax payable. So when Home Depot sells materials, you know, whenever we buy something, if we any of us go to Home Depot, we get the sales tax. I wish it was 5%. It's closer to 10% in San Jose and California. And so they actually have to record that when we get the sales tax, the business itself retains that sales tax. And then when it retains it, it remits it, it gives it to the government every single quarter. And so it has to keep a bank account that retains all of this sales tax in order for it to pay to the government. And so whenever you're paying it, you know, you buy a $10 sandwich, or nowadays a $20 sandwich, and then you get a $2 sales tax attached to it, the company doesn't get the sales tax, it's going to the government. And they have to record a journal entry for that because that's a liability. Like they received cash, but they have to give that cash to the government every single quarter. And so in this situation, you debit cash, credit your sales, and then credit your sales tax payable. That's one of the reasons that I love professional service businesses. And I think accounting is a great profession because there's not a sales tax on professional services. There's a sales tax on products, right? Which really reduces profitability in a lot of ways and complicates accounting. Unearned revenues. So deferred revenue, this is a big one and can actually be rather complex. But we'll keep it simple for this class. Unearned revenue. On June 30th, we sell $5 billion. Rihanna sells $5 billion for 8 concerts. So on the day that we receive the cash in exchange for a future promise, a future performance obligation, the performance obligation is the promise, we would credit a deferred revenue or unearned revenue account. What that means is we have a liability to perform an obligation. If we don't perform this obligation, the customer has a right to the cash back in some regard, right? So we can't recognize the revenue to this because it would violate the matching principle. We have to match, not the matching principle, the revenue recognition principle. We have to recognize revenue when it's earned, right? When we satisfied our performance obligations. And so we collect the cash. We can't recognize the revenue until we perform the concerts. In this case, they performed one concert. 5 million divided by 8 is 625,000, which is why we recognize the 625,000 in revenue. If we have put our critical thinking hat, we really should be recognizing revenue not by concert, but by the number of tickets sold, right? So I would say this is a good example of what to do wrong. And this oversimplifies the revenue recognition. We should actually see maybe the first concert or this concert had more tickets than the other concert. But this is just an example of how deferred revenue can be recognized. So that's deferred revenue. And I know we've done other examples of when we're talking about accruals and deferrals about deferred revenue. We're just trying to bucket all the short-term liabilities. Next one is we have short-term notes payable. So short-term notes payable are written promises to pay specified amounts within 1 year or the company's operating cycle, whichever is longer. But we're going to talk about 1 year here. So notes given to extend the credit period. So what were we really talking about here? We're saying, what if I go to the bank and say, I need $100,000 for my business, and the bank says, okay, you have 1 year to pay it. Well, that's a short-term, that's a current liability. I can't call that a long-term liability on my financial statements. And so on August 23rd, Brady asked to accept $100 cash and a 12% $500 note to replace his existing $500 accounts payable. So these are where these transactions can get a little more complex. So we're saying instead of an accounts payable, so McGraw has said, hey, we know you can't pay in the short term. So instead of you paying in the next 30 days, we will accept $100 in cash today, and we're going to give you a loan of the $500, but you need to give us interest on that loan. And so on the day this occurs, where we're trading out the accounts payables, from the account payable side, we'd debit our accounts payable, we credit the cash for what we paid, and then we'd credit a notes payable for the $500, because we've said, hey, we're going to take on that $500 loan. We can't pay the $600 in the short term. All we can pay is $100 today and $500 in a year. And so remember who we are in this transaction, right? We've gone over the assets, right? So from the lender's side, they would be having a short-term notes receivable, but we are now looking from the debtor's side. So would have a short-term accounts payable. And then, of course, because we have this accounts payable, we would then have to recognize interest. This notes payable, we'd have to recognize interest based on the interest rate and the dollar amount of the basis. So we have the $500 notes payable. We take it, multiply it by 12% if we paid it in 60 days, and then we prorate the year. So 60 divided by 360, and that would give us our $10 of interest expense. From the payable side, remember, if this is an asset, it would be interest receivable. And so this would be us paying off the note in 60 days plus interest. And so what changes it into a note is now we're saying we're charging interest. It's going over the accounts payable policy. What about a note given to borrow money from a bank? So we go to a bank and we borrow $2,000 from the bank at 12% interest for 60 days. So that's no longer an accounts payable, it's a notes payable, because we're borrowing the money. We're not paying for something explicitly. We're really just getting cash in exchange for us promising to pay back that money in the future. And so the most traditional long-term notes payables we can think of are mortgages. But in this situation, we are just borrowing money from the bank, similar to like having a credit card. And so in this situation, we do what we've done before. We debit cash, credit our liabilities, our notes payable. Remember, this would be a short-term notes payable. And then once we pay it off, we would just debit our interest expense, credit our cash for the full amount, and remove the notes payable from our books. Right, notes payable is a liability, just to refresh. Liabilities have a credit normal balance, so we use a debit balance to reduce them. And so our notes payable would wash. We'd have notes payable no longer on our financial statements or on our trial balance. Our cash would be reduced by 2040, and the way to get the interest expense would be the $2,000 of the loan multiplied by the 12% and then prorated for the 60 days in the year. I would go over these calculations, but I think they're simple enough. We've done so many proration that If you aren't getting it at this point, meet with me on one-on-one. I don't want to waste everyone else's time. When note extends over the period end. So what happens over period end? We had a whole chapter on adjusting entries, right? We went over what those adjusting entries look like. And if you have it at the end of the year, if you have a cutoff issue, we talked about cutoff issues where we have a note that was released in the middle of a year and it's due in 1 year, or partial depreciation expense, we have to do adjusting journal entries at the end of a period or a year. And so same thing happens for interest expense. And so that's where we do these end of period adjustments where we haven't paid the cash, but we need to recognize the expense related to it. And so if on December 16th, we borrowed $2,000 at 12% interest for 60 days, what would be the adjusting entry? We just multiply the 2,000 times 12% times the number of days, the 15 days, divided by the 360, which would be $10. So that's our interest, and then we debit interest expense, which would hit our income statement, and we'd credit our interest payable, which is a liability, right? And that liability would go into our balance sheet. And then on February 14th, when we pay the note, we would debit our interest expense for the remainder 45 days. We debit our interest payable, the liability that we put on our bank, on our balance sheet from our adjusting journal entry at financial year end. And then we debit our notes payable and then credit the cash for 2040. So this is the same as the other entry we did, but the only difference here is that we had to do an adjusting entry at the end of the year because we crossed periods. This is the exact same as we've done for all of our other adjusting journal entries, so I'm not going to spend too much time on that. So let's go over an example. A retailer sells merchandise for $500 on June 30th. The cost of the merchandise is $300. Remember our cost of goods sold entries when we were doing inventory accounting for our asset lectures. The sales tax law requires the retailer to collect 7% sales tax on every dollar of merchandise sold. Record the entry for $500 sales and its applicable sales tax. Also record the entry that shows the remittance of the 7% tax to the state government. So that was that first lecture we were going over. We just debit the cash for $535. How do we calculate the $535? We take the sales tax payable, which is 500 times the 7% here. 500 times 7% gets us our 35. We know that it's $500 cash, so the $500 cash plus the 35 equals our 535. We are receiving cash, right? Cash is always a debit because cash is an asset. Assets have a normal balance of a debit account, and sales tax payable are credit balances, right? Sales are revenue. Revenue increases our income statement, which increases our equity, and then sales tax payable is a credit because it's a liability. Then we also have our cost of goods sold and merchandise inventory journal entry, which we learned in our inventory accounting, right? That's where this all comes together, is we tie the inventory accounting so that $300 is our cost of goods sold. So then remember, our gross profit would be our 500 minus our 300. That'd be our $200 in gross profit. And then when we actually finally give the sales tax to the government, we debit the sales tax payable to remove the liability and credit our cash to remove the cash from our books. Let's talk about the deferred revenue. Deferred revenue, a ticket agency receives $40,000 in cash in advance. Ticket sales for the 4 dates at High-Am, we're going to do it by a number of concerts, right? I'm telling you that that's not correct. I would do it in a different way, but for the sake of the book, we'll just do it for what they've given. And then record the revenue earned for the first concert date on May 15th. So simple, we've done this before. We just debit cash, credit unearned revenue. We do that because of accrual-based accounting, right? We can't recognize the revenue yet because we haven't earned it. And then that's for the full $40,000. Cash is an asset, unearned ticket revenue is a liability. And then the unearned ticket revenue, we're prorating it by the number of concerts, which would be the $10,000 in reduction in liability. And then we'd recognize revenue of $10,000. And so that we debit that liability to reduce it and credit the revenue to increase it. And this last piece is notes payable. And so the notes payable, we debit cash of $8,000, credit notes payable of $8,000 on day one. That's our debt, where we're borrowing cash in exchange for a promise to pay that cash back to the bank in the future. That promise is a liability. That's why we have a notes payable. Then on December 31st, we're going to have to prorate the interest. The interest is coming from, we have a 5% interest, so 5% times the principal amount, the $8,000, prorated by the number of days, which is 36 divided by 360. I'm not going to do the math. It's self-evident here. If you multiply that out, you get 40. So we debit our interest expense at financial year end for 40, credit our interest payable for 40. And then finally, when we actually pay the debt, we prorate the remaining amount as interest expense for the next year, which is 60. Interest payable would be reduced because we were going to pay off the liability. We'd reduce our principal balance because we're paying it off, all in exchange for paying off our cash of 8,100. So any questions here? I'll stop sharing. I'll pause. Give us all a few seconds to talk through this.